Have you ever back-tested a trading strategy and it looked amazing? And then when you go to forward test the strategy, it ends up failing? If so, then make sure you watch this entire video. In it, I'm gonna explain exactly why this happens, what the inherent flaws of backtesting are, and what you can actually do about it to make sure that this doesn't happen. So before we dive in here, I have to set the premise. So we actually hired this developer, we paid him a whole bunch of money to develop this trading strategy for us. When he sent us the backtest report, it looked amazing. We're like, oh my God, this thing is really, really good. I mean, the graph was pretty much straight up and to the right. And so it looked really good. And so we decided to start testing it on the forward live tested market with our own accounts. And it worked really good for like a month and a half, 2 months. It was like insane. Like we couldn't actually believe the results that we were getting with this trading system. And then pretty much right at 2 months, the thing stopped working. It ended up just completely failing. I mean, it ended up going to nearly to zero. We just let the thing run and it went almost to zero. And so at the time, I didn't really understand why something could perform so well in a back test, but then in the forward test, it ended up sucking so bad. And so it wasn't until I actually met with a few other really experienced algorithmic traders that had been building and developing algorithms and trading for like 15-16 years that things started to make sense to me. So in this video, what we're gonna do is we're gonna cover what the inherent flaws of backtesting are. I'm gonna talk about the benefits of backtesting, and then most importantly at the end, what you can actually do about it. So what are the main benefits to backtesting? Because ultimately it's a good idea to backtest versus not backtesting. And this applies whether you're trading robotically or if you're trading manually, you should always backtest your trading system. And backtesting is similar to like in sports that you're gonna practice, right, prior to the game. And it doesn't necessarily mean that you're gonna be successful in the game and you're going to win. But if you practice prior, then you're gonna have a higher likelihood of actually having success in the game, right? And so this is the whole idea behind backtesting, is to increase our likelihood of actually having success in the forward tested market. Now, some of the main benefits with backtesting are, number one, it's going to prepare you mentally or psychologically to get an understanding of what you can expect from the system, meaning what is my win rate? What is my average winner? These sort of things. What is the drawdown that I should be expecting? So this is going to start to prepare you psychologically. And also when you backtest a trading strategy, whether it's algorithmically or manually, it's also going to increase your confidence in the strategy versus just coming up with some strategy from your head and going out and plopping it onto the forward tested market or the live market. The likelihood of success is very, very low. The next thing is that backtesting also gives you a benchmark of performance. So we know that in the backtest, if the strategy said that, hey, you should only expect 10% drawdown, yet you're seeing 20% drawdown, then you may know that there may be something wrong with your system, or you need to change something about your system, which we're going to talk about later on. So it gives you some sort of benchmark of success of what you could expect. The other benefit to backtesting is the fact that it can identify areas to improve. When you backtest, you can see how things perform, and then you could look for things that are lacking or things that you could change or things that you can optimize to make the strategy perform even better. These are some of the benefits to backtesting that maybe you're already aware of. And now let's go ahead and let's talk about some of the flaws of backtesting. And you've probably seen this disclaimer all over the place that past performance don't actually indicate future results or don't guarantee future results. And that's absolutely true. Just because something's performed well in history or has performed well in a backtest doesn't necessarily mean that it's going to work in the live market. Just like in sports, just like how, the Warriors won the NBA Finals last year, that doesn't necessarily mean that they're going to win the NBA Finals this year, even though I hope that it does happen. So some of the inherent flaws are, number one, is that backtesting has no way to account for an ever-changing market. As you know, the market is always changing. I mean, every day the market is different. Every week, every month, the market is different, and especially every year. If you look at year-to-year changes on euro dollar or in the gold market, the indices, all of these markets change over time. So backtesting has no possible way to know what's actually going to happen in the future. And as we know, the market is in a random walk. One of the things that backtesting cannot account for is huge news events, right? If Trump were to get on and say that he's running for president, that could really move the markets again, right? Or nobody could have seen in a backtested environment what happened with COVID-19. No backtest can account for these sort of things that are going to happen in the future. Yes, and there's going to be weird events that happen in the future. However, backtesting has this limitation because it can't predict the future, obviously. Now, another limitation or flaw to backtesting is a lot of the times that a strategy can work on one broker's data, but it may not work on another broker's data. This is because of things that are variables among broker to broker. Things like the spreads, things like fees, things like commissions. If you're trading with a robot or expert advisor, things like your delays in your VPS. So when backtesting, it's best to find really high quality data like from Alpari or Dukas Copy. And it's not really advised to use your broker's data because, as we've seen many times, there's a lot of times really weird stuff happening in broker's data. And one broker's data is going to be very different from another, as well as their live market. Their servers are going to be different from one broker to another. Another flaw with backtesting is that it can lead to a problem of curve fitting, or what's called overfitting also. And what this simply means is that basically you're fitting to the historical data too tightly. Now, what does that mean? Generally, a lot of the times, if you use a whole bunch of different indicators and you tune them really tightly to historical data, it'll make the backtest look really good. But if you use too many indicators and too many things, then when you go ahead and you test it in the live market, it doesn't perform as well because the strategy is not super robust. It's very tightly fit to history, but that doesn't mean when you what we call break it out of the box, which is, again, if we back tested or optimized over the course of a year, if we take that to like 2 years ago, it's also likely not going to perform well in the future. And another inherent problem that I see with back testing is that it oversets your expectations. And when you have high expectations and then the event actually comes and it's not as good as your expectations, then this causes you to become sad, right? Because you expected something great and it's not as great as you would think. So this is actually a really big psychological problem that I see for people when they see amazing backtest results and then they live test it and it's not as good. So a way to combat that is we always, when we're trading any of our algorithms, we always assume that the strategy is going to perform worse than it did in the backtest. And I think that you should assume this as well. This is something that we teach our group of traders, that, hey, even if something backtests really amazingly, that is a better sign of success, not doing a backtest or having a backtest that performs like crap. Also, at the same time, it's important to know that it's likely not going to perform as well. Maybe you'll perform 80% or 70%, 60% as good as the backtest if you're doing things correctly. So far, we've covered the benefits and the flaws of backtesting. Now let's talk about what do you actually go ahead and do about this. So first things first is backtest. Okay, backtesting is a lot smarter than not backtesting at all. So make sure that you do in fact backtest any trading strategy. The second thing is, when you're looking at the variables that you are adjusting for, this could be things like the moving average period. It could be like your take profit level, your stop loss. It could be, the certain currency pairs or the certain times of days that you're trading for. What you want to do when you gather this data is you don't want to look for outliers, meaning that you don't want to just look that says, hey, if I have a 10 take profit, this resulted in the absolute best performance. This was by far and away better than everything else. You want to look for trends, not these outliers. So what do I mean? So if a 10 was the best outlier, but we saw that, most things like a 22, a 23, a 24, 25, and a 21 take profit all performed pretty good, maybe not as good as a 10 take profit, then you likely want to go with this trend because there's a wider range of variables there that were still successful, even though they're not quite as successful. So you want to look for trends, not these outliers. The next thing that I think is very important to do is to take your system out of the box. So what does that mean? That means that if you optimized or you back tested for a period of 3 months, then what you want to do is, if you get a good result on 3 months, then you want to run it over the course of the past 6 months and see how it did. And if it did good on 6 months as well, then this is a great sign. And then you may want to go to like 9 months and you may see that, hey, this is a good sign as well. And then you'll take it back to 12 months and maybe you'll go even further than that. You want to optimize for a certain period of time and then you want to break it out of the box. So you can break it out of the box by testing it forward, which is obviously something that you should do as well. But if you want to get an idea of the robustness quicker, then just break it out of that box of that time period that you're optimizing for in historical data to get an idea of the robustness. And the last thing that I would say that will really help this from happening is to realize that the market is always going to be changing, right? It's just inevitable that the market changes. If you look anytime throughout history, it's never really the same, right? It's always changing. And so the last piece of advice would be to re-optimize regularly. So you could re-optimize every month, or you could re-optimize every 3 months, or whatever period of time you see fit, but you want to re-optimize re-optimize your strategy because market conditions have changed. And especially you want to re-optimize if it's fallen outside the scope of what you saw in the back test. Again, if you saw that in a back test, it only did a 10% drawdown, but you're at like a 15% drawdown, then this may be something that you're like, hey, the system's not working as well as expected. It may be time to actually go back to the drawing board and re-optimize due to the changing market conditions. So one thing that we've done, you may have seen me talk about this before if you've watched some of our videos, but we've basically built trading systems and expert advisors to help pass prop firm challenges. And so one of the things that we do is we track for what is the phase one success rate. So we can see here this strategy over the course of the past 52 weeks, it went ahead and it actually passed 92% of the time. It looks like it had 2 retakes, had 2 fails, and the rest of the time it actually passed phase one in this 52-week back-tested scenario. We can also see that it took about 11 days to pass a test, which if you're not familiar with prop firms, basically you have to do a 10% profit with no more than 5% daily drawdown or 10% max drawdown overall. Now, the thing that makes this, I think, different than other things is re-optimize our strategy is that we have a whole group of people that are using our product that are constantly feeding data back to this leaderboard. Anytime there's a strategy that's working best in the current market condition, then it floats to the top of this leaderboard. And anytime a strategy's fallen out of what's working in current market conditions, then it sinks to the bottom of this leaderboard. So this is how we're able to constantly re-optimize because we have tons of people that are all using our product that are feeding data back. So as a community of everyone that uses this, it just gets the results better and better for everyone that's involved. And if you'd like to be a part of this group of algorithmic traders, then go on over to propfarming.com and you can see more details about this. But even if you don't have our system or you can't afford to become a customer or want to be a customer, that's totally fine too. My suggestion is that you want to continue to re-optimize your strategy as market conditions are changing, because if you don't, then you're going to get left in the dust. Hey, the next thing that you need to do right now is watch this video on screen. I interview an expert developer and he basically talks about 3 different things that you can do to optimize your trading strategy to make it perform even better. So go ahead and check that out right now.